The Federal Reserve has paused its 15-month-long rate hike campaign last week, but Fed officials are expected to maybe raise rates again this year to tame stubborn inflation. Powell's so-called hawkish pause has investors struggling to interpret if the Fed is indeed staying on course or sending mixed messages. Let's bring in Matthew Luzzetti, Deutsche Bank Securities chief U.S. economist, to weigh in. We've got a lot of Fed speak this week. We've got Jay Powell himself speaking. What do you think the sort of message management is going to be?
Yeah, I think the message that we got from Chair Powell last week was pretty clear.
It was pretty clear.
I think it was pretty clear that, look, they are not raising rates at the June meeting. The reason that they are doing so is they're waiting for the lagged effects of monetary policy. And they're also trying to see whether or not the banking sector is tightening credit conditions as we look ahead. I think the second aspect of the clarity there was it was a skip or a temporary kind of pause in the hiking cycle, but that they do expect to raise rates again. We expect that they raise rates again in July. And their dot plot was even more hawkish than that, showed 50 basis points. I think where kind of the ambiguity came in was, why are they pausing at the moment if they think they need to do at least 50 basis points more in rate hikes? And I expect that Chair Powell will get questions on that this week.
Why do you think they did?
Yeah, I think you have a committee that is very diverse, is seeing different things, is seeing risks skewed on each direction. But I think the reality is, look, they've raised rates by 500 basis points since last March. They've undertaken the strongest or most aggressive unwind of their balance sheet. Over the past several months, they've seen several major banks in the U.S. go down, and they think that that's going to be a tightener of credit conditions. And so they think that they have some time to be able to assess these things as they go along here. At the same time, it's very clear they marked up their inflation forecast by 30 basis points. They expect core PC to be at 4% at the end of this year. So I think they're also sending a clear signal that there's still work to do.
Do you think that the Fed is even allowed enough time for the interest rate increases to make their way through the economy? In other words, are we really going to have that much more information in July than we have right now?
Yeah, I think Chair Powell was asked exactly about that.
Right.
We're only going to get from a major data release, we're going to get another jobs report, another CPI report. And he was asked, is that enough really to change your view for July? His response was, we're going to be taking into account all the data since the last time we hiked rates in May. And the data that we've seen so far, I think, pretty clearly tells them that they should keep raising rates. And so the bar for a July hike, I don't think is all that elevated. I think it's that they really only need to see the data kind of remaining as it is. We got very strong housing data over the past 2 days. If the labor market remains resilient, inflation remains a bit elevated, I expect that they'll raise rates again in July.
So I guess the only thing that would make them deviate from their set path at this point would be really some outlying, some data that would be surprising in some way, some kind of dramatic disinflation, for example, or something in the job market that we don't expect.
Yeah, I think maybe two things I would highlight. One is certainly the labor market. So we'll get another jobs report, but each week we're getting this jobless claims data. We'll get it again on Thursday. And it's been notable that initial jobless claims have been rising pretty materially. They're very clearly above 2019 levels. So far, it hasn't creeped into continuing jobless claims, so that's something to watch over the coming weeks. And then it's the banking sector. Are we seeing any stresses that are still there? We'll get reports from the banking sector over July. Every Friday we get data on the bank balance sheets that has shown pretty material declines in things like C&I loans. And so that credit conditions tightening, I think, is ongoing. The key question for the Fed is it doing enough tightening from their perspective, or do they need to do more from a Fed funds rate? I think they'll need to do more, but only one more in July.
Matt, you guys at Deutsche were early on the recession call. Where are you now? Because as the sort of conventional wisdom has shifted from the recession is imminent to this is a recession that we've been calling for a while now and has not yet arrived. Have you guys shifted your thinking on this at all?
So we haven't much. For our view has always been at the end of this year in terms of recession. We didn't really pull it forward as much as maybe consensus did late last year and early this year. And so we've stuck with the view that we still expect that you get a modest recession by the end of this year. It's really predicated on seeing a downturn in both CapEx and in consumer durables and goods spending. And I think as you get towards the end of this year, you see excess savings come out of households' balance sheets, you see student debt payments come back, and we are seeing a weakening labor market. That said, we've kind of noted there's risk that the economy remains more resilient than we expect here. If we've seen persistent surprises, it's been in one direction. It's been the labor market being stronger. It's been inflation being more resilient. And so if I view, kind of the risk to our view, it's that the recession certainly does take longer to materialize, and that the Fed may have to do more than what we've built into our forecast.
Remind me, has yield curve inversion ever been wrong in predicting a recession?
You have examples in the past. I think something that is unique now is there's three key yield curve indicators that we would focus on: the 2s10 slope, the 3-month 10 slope, and there's this other one that the Fed focuses on. It's kind of a forward spread measure. All three of those are deeply inverted. I don't know that you've seen all three of those showing such a clear recession signal without a recession actually following. Now, I would note there are some mitigating circumstances here, which is the Fed has raised rates very high. They're well above neutral. And even under the Fed's forecast, where they don't have a very material recession, they expect to cut rates. And that's because they can kind of bring rates down as inflation moderates. So there's some uncertainty about what the yield curve is pricing here. It's very clearly pricing cuts. It's less clear that that's driven by recession versus moderating inflation.
Right. Interesting. And it's interesting now because you do have this sort of disconnect between market participants on that front, consumers whose sentiment has sort of been all over the place, but not terrible, and then companies whose tone has not been that negative, right? You've had a lot of cuts in technology, et cetera, that have really slowed down. So it feels like the signals, especially sentiment signals, are unusually mixed right now.
I agree. I think if you look at the typical key indicators, we talked about getting the PMIs on Friday. But if you look at the manufacturing ISM, the services ISM, both of those are at levels that are typically associated with recessions. If you look at bank lending conditions from the Fed Senior Loan Officer Survey, I think, again, associated with recessions. If you look at the index of leading economic indicators, we've never seen a 6-month decline happen without a recession taking place. And so there's these typical reliable leading indicators that have all been kind of blaring red, I think. At the same time, you're seeing some of the most interest rate sensitive sectors beginning to bottom and bounce, and we saw it with the housing sector today. And so I think really what it is about is this has been a very unsynchronized cycle. Mm-hmm. You had the housing market absolutely collapse while services and manufacturing kind of hung in well. The recession that we expect is very different because of that. We expect housing to be only a very modest drag, and it's really CapEx slowdown and consumer durables and goods spending that drives it.
What is the biggest element keeping us from entering recession right now?
I think it's this just very positive dynamic that we've had for the most part between the consumer and labor market. And so you've had a very resilient labor market producing decent income and wage gains, helping to support a consumer that has remained more resilient than expected. And above that, you've had that excess savings has been a really important driver of that as well. I think you've seen some early cracks beginning to show in that. If you look at delinquency rates on auto loans or credit card loans, those have been very clearly on the rise. If you look at retail sales surprised to the upside last week, but real retail sales on 3-6 months basis, they have been declining. Consumer sentiment is actually, on the metrics that we would look at, kind of recessionary. It bounced a little bit, but it unwound the decline that you had seen due to the debt ceiling. So all these things, I think, are still showing that the economy is slowing as we look ahead. The question is, can you kind of thread the needle and slow enough without inducing a recession for the Fed? Or do we kind of go over the cusp from a recession perspective? Our view is still that we tip over and see a moderate recession.
Okay, moderate, the key word, and the hopeful word here, I guess, if we're talking about a recession. Matt, thank you so much. Good to see you. Matthew Luzzetti is Deutsche Bank Securities Chief U.S. Economist. Appreciate it.